Let's talk about the pre-formal due diligence and what you can do. This is before you have an agreement in place, but stuff you could start working on immediately. Remember, you can't wait until there's a signed deal. Your investigation starts immediately. As soon as a business is of interest to you, you can start digging into the due diligence, not on a superficial level, but on a good level to really start getting some information. First of all, you got to learn how to read financial statements and tax returns. You need to know how to read financial statements, because if you have to send your financial statements of a business you're interested to your accountant every time, you're going to spend gobs of money on accounting fees on things that you could have easily done. It's not that difficult. You just have to get, into the practice of doing it. Like my late partner Devin used to say, something new. If you want to learn how to play tennis, you got to keep hitting tennis balls. So you may not get. The other thing is, keep in mind that you may not get detailed financials, but that's okay. It's enough for you to start formulating your questions. You could assemble your questions for the seller and or your CPA, but that's after you've reviewed them. Look for discrepancies. So I like to get from the seller 3 years of detailed financials: revenue, cost of goods, gross margin, gross profit, and then a detail of all the expenses. And you could look line by line by line to see any discrepancies, because oftentimes they're going to put lipstick on a pig, and they all of a sudden they cut their marketing fees, or an employee quits and they don't replace them. So you'll see that payroll drop significantly, or marketing expenses, because they got getting their business ready for sale. And so they're cutting their expenses to make the bottom line look better, and it's not a reflection of reality. What's the point of modeling? I get some of the most fabulous Excel spreadsheets from some of the smartest people from the best schools, business buyers who send me things and ask me for an opinion on something. And you know what? It's great. Those pivot tables are great. I don't know. Like, I graduated #1 in the province of Quebec in math, and I still can't. I don't even know how to do a formula for an Excel spreadsheet, but I know how to read a financial statement. The point of business modeling is great, but you're trying to predict the future, and no one knows what that looks like. So your time has to be spent following commandment #1 in the 10 commandments, which is pay for the past, consider the present, and buy it for the future. You're basing your valuation on the financial history of the company. The other thing that you need to do when you're looking at these financials and you're putting together these wonderful spreadsheets of best and worst case scenarios. Worst case scenario does not equal growth. So when if you're in a situation where you're going to look for third-party investors to help you finance the deal, and you go to them and you present a spreadsheet of what the future looks like, and you show that the first year you're projecting 3, 5, 7, 10, or whatever percentage growth, they are not going to be impressed at all. And a lot of them are going to shut you off completely. Worst case scenario means no growth, or means a decline. And so when you go out, and the reason why I'm trying to emphasize this with everybody is, when you make those presentations, you don't want to come across as someone who's unrealistic. Reality dictates that worst case scenario, or reality for the first year, is the business is going to hopefully be status quo, stable, and there may even be a small decline. So don't paint your worst case scenario as a 10% increase, because that's just not reality. It's not believable, and you're going to get shut down. The market and industry outlook, something else that you could do pre-due diligence. Is it local? Is it national? Is it what are the macro trends are okay, but use common sense. And what I mean by this is the following. I was working with a particular buyer, and we're acquiring a moving and storage business in South Florida. It's a pretty significant business. And the deck from the broker started out, and I made a note here because this was verbatim. I dug it up. It said, moving and storage is a $20 billion market in the USA, blah, 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 and went on to have all these macro trends. And we're saying, well, like, what does that have to do with buying a moving and storage business in Miramar, Florida? It's not even relevant. And so you need to understand that the data that you want to get, you've got to get it specific to the area that you're looking and where that business operates. Yes, it's important to understand what the overall picture looks like for the industry, and that could be a macro trend. But we're trying to get metrics and data points related to a business, make them applicable to the business. What business, what moving and storage companies do in Omaha, Nebraska has very little to do with what the market may look like in, again, Miramar, Florida. You can get multiples in terms, read comments, call sellers and brokers for every single other type of business listed for sale, meaning that when you're looking at a business initially and you've identified a particular business, use the same case, a moving and storage business, well, call brokers and sellers for every other one that's listed for sale and have the conversation, because you're going to learn something. And again, this is all done early on. You can call and visit other like businesses, never direct competitors, and ideally in another city. But I found that it's very helpful. I'll call an owner of a business for one that I'm looking at, perhaps in Fort Lauderdale, and I'll call an owner in Jacksonville or in Topeka, Kansas, and say, hey, I'm thinking about buying this commercial cleaning business. In the Southeast. I'm wondering if I can ask you a couple questions. Would you mind answering a few questions? Most people are very helpful, and if you can go into the next town over or a couple of towns over and meet with someone face to face, even bit better. But some of the questions I like to ask: if you were me, what would you look for? What would concern you? What profit margin percentages are acceptable? What are your biggest concerns and challenges? What do you like most and least about the business? And again, people generally are helpful. And so if you can line up a network of a business owner or business owners in same industries, it could really give you a whole incredible lens into the business that you're looking at. Let's talk about the competition and what you can do initially. So when it relates to the competition, there's a lot that can be done. You definitely do not want to rely on the seller for this information. So you definitely do not want to rely on the seller for this information. This is very often in smaller businesses, either just the owners of the business, they just don't have a good sense of the competition. They may know who they are, but they don't really know enough about them. And so the information that you get to the seller, this is one particular place, you've heard me mention it before, that you listen to everything the seller has to say and the broker, and you believe nothing, you validate everything on your own. This is a really specific category because they just usually don't have a good understanding of it. And we'll give you an idea now of a quick case study of a client that I was working with. They were looking for a sleep clinic in Tampa. It had big margins, but the revenues were dipping a little bit each year. And the client already did the initial research that we lay out in the course to determine whether her skills match this business type. And she felt pretty confident that they do. And she was very astute individual. The key points that she had taken away from this was one of the client's 5 golden rules. When I took the buyer client, a client of our course, How to Buy a Good Business, a Great Price, one of her 5 golden rules, and we talk about this in earlier webinar. It was a high margin business. She really liked that. The initial SIM, or the deck, plus other businesses, similar businesses that she looked at online, she found that they would describe sleep centers, sleep clinics, and sleep labs. So I'm trying to just give you some good bullet points related to how she went into this investigation. And really what she was excited about, 2 main things. Number one, this seller told her that there were only a handful of competitors in the area. And number 2, the big growth areas, she was in Tampa on the East Coast, we're in Boca Raton, which was always interesting to me, that's where I live, and Hollywood, Florida. But it struck us as odd because if there was only a handful of competitors in the area, why would the owner why wouldn't the owner want to expand locally versus 200 miles away? It sort of, those 2 things didn't conjugate. So we knew we had to do some additional investigation. And anybody, if anybody wants to jump in and have some ideas how you'd go about doing this related to the initial investigation, this is pretty generic, but here's some of the things we found. And keep in mind, the 2 main points were there are only a handful of competitors and there's big growth in some other areas. And so the first thing that we did, obviously, is we looked at and found out, because one of the questions was, what is the difference between a sleep center, a sleep clinic, and a sleep lab? Because this was a sleep clinic and she was coming across other listings that talked about sleep labs. So the first generic thing that you would do, which is pretty obvious, but you want to know that information, is you Google what is the difference between a sleep center, a sleep clinic, and a sleep lab. Hopefully everybody could see my screen. So it gave the definition here that sleep clinics and sleep centers are used interchangeably. So that's great. But sleep labs are testing sites. And some of the testing sites offer outpatient treatment. So now she went in and at least was able to say that these are the differences between the two. So anything that they looked at online, understand whether it's a sleep clinic, stroke center, or a lab. The next thing was, if you recall, they said that there's only a handful of competitors. So very simple. Looked up Tampa sleep clinics, and there were 22 of them. Now, I don't know about you, but to me, only a handful means like 5 or less. And as it turns out, the area of the one they were looking at was right here, where there was about, I think, 7 or 8 of them right here. So it's like, oops, okay, well, a handful, it could be 5. It's certainly not 22. So either the seller didn't know what they were, didn't know the competition. They were either full of it, clueless about the market, or maybe both. And so that changed the whole dynamic. And that is why we started to realize that that's why they were looking to potentially open up in areas that were 200 miles away. So when probed further about those areas, it was a similar sales pitch from the seller about those being good markets. And so the next level of investigation was, okay, are we going to find the same thing there? And which basically took the population of Tampa divided by the number of sleep clinics in the area and determined that there were 5.7 clinics for 100,000 population. Hope everybody's still with me on that. That was just math. Then we looked at Boca Raton and we looked at Hollywood and discovered that those territories were worse. Boca Raton had 16 clinics per 100,000 and Hollywood has 14.47. So it became very apparent that either the seller was trying to do a wholesale job or really had no clue about the market, and expansion locally was not going to be possible. And you don't want to start buying a business and then having to look at expanding 200 miles away. Why I'm trying to impart this to you is this is information, easy, almost generic. You just have to think about it in the right way. You could learn this before you start putting in formalized offers, spending money on accountants, spending money on attorneys, negotiating LOIs. This is all stuff that you could do on your own early on. And believe me, if you have any business that you're not certain how to go about this, you can email me anytime and I'm happy to help walk you through that. But it shows you how important it is to do your pre-formalized due diligence. Because if not, had she gone through and hired the accountant and attorney, and then you have dead deal costs, I guarantee you by accident, she would have spent $10,000. Could have spent 25, but easily, like as sure as God created little green apples, she would have blown $10,000. And so that's why it's really important to understand what you have to do early on. And it's not sending men to the moon. This is not rocket science. This is just a lot of common sense. And you're looking at the business. Okay, let's talk about the last couple of stages of early due diligence. So learn how to read a sim or a deck. This is the way I read them. Once I read through the whole deck without taking any notes, and then I read through it a second time and I take notes and I break it down into questions that I might want to clarify with the seller or broker, or things that I want to investigate on my own. This is your template, your working document. So when you get a deck, yes, there's a lot of sales pitch stuff in there and it presents the business in a certain light, but there's also, if written half decently, it's going to present you with a ton of information. So you read the first thing. I like to read it again without taking any notes, because oftentimes a question that I have gets answered later, but you could read the whole thing and then take your notes, and that will very often be the trigger for what you could investigate independently. You want to look for such items like specialized licenses if they're required for the business. Do you have them? Who does in the business? Can they be attained, transferred? Are there any local laws? Is there any lease expiring shortly? What else may be available nearby? If it's a destination location, it may not even be worth pursuing if there's an expiring lease that you can't. If it's a destination location rather, and you can move it, it's fine. But if it relies on an anchor tenant, that changes the whole dynamic. If it's a retail location or something of that nature. If there's real property involved, is it or can it be or must it be included in the deal? And if it's not, you may have to acquire the business without the property. You want to look for other potential locations. And there's not that, not all businesses rely on its location or its property, but if it does, you have to investigate that. So, contact a commercial broker and you can get some comps. This is especially important if real estate is included or must be included with the transaction. You've got to get ahead of what is the property worth, because the seller may be asking $5 million for the property and it's worth $3 million. And that's binary. I mean, you get comps and you can find out what it's worth, and it's based on an appraised value. If two owners are leaving, what are the replacement costs for one? Then you can get some margins and industry metrics. I've given out this referral before. Bizminer.com, bizminer.com is a terrific platform for providing metrics, very granular metrics of business types in local markets. It's worth subscribing once you have a business in mind, so you can verify some of and compare and contrast some metrics.